My name is Chris Wetherbee. I'm the transportation and shipping analyst. I didn't see you at lunch. Welcome back to the afternoon sessions. We're going to kick off with the crude oil tanker panel. Very pleased to be joined by a number of really insightful folks from the industry here. So to my left, I have Brian Gallagher, who heads up investor relations for Euronav. Lois, Zabrocky is the CEO of International Seaways, to Brian's left, and then Ted Petrone, Vice Chairman, Navios. I have Robert Burke, who's the CEO of Ridgebury Tankers, and then Nick Tsakos of Tsakos Energy Navigation, who's joined us as well. So really, I want to make sure this is interactive so we can get the audience involved, and hopefully you guys have questions as well. But, I think probably the best way to kick off the panel is dig a little bit into the fundamentals and talk a little bit about supply demand. Obviously, IMO 2020 is what everybody wants to talk about and is talking about, so we'll talk a little bit about that too. I'll make sure to get each one of your targets on exactly when rates are going to inflect later this year. And if you could get it by the week, that would be great, but I'll take month. That's fine too. And then we'll just sort of wrap up and sort of think about the longer term view for the industry and the stocks specifically. I'm an equity analyst. I care about what the stocks are doing. We talk a lot about what the industry is doing, but ultimately we do want to know how you guys think about the equities as well. So maybe I'll kick off. So let's talk first a little bit, about supply demand and just generally how we think about sort of the looseness or tightness of the market. Maybe Brian, I'll start with you. You and I chatted a little earlier in the day. I thought it was an interesting comment about your perspective on what spot rates have been doing and what maybe would otherwise be a kind of slackening period of the market. So sort of what's your broad take right now?
I think from a Euronav perspective, we
there we go.
Identify a couple of things. There's a two-tier market developing in the VLCC space, the Atlantic and then the Arabian Gulf market, and you're getting better rates in the Atlantic than you are elsewhere. The Suezmax market still remains challenged. We had a very, very heavy supply schedule in 17 in the Suezmax, which is still causing a lot of over-tonnage in that market. But one thing that's impressed us is that we think that Q1's going to come out on V's about $35,000 a day, which is about the same as we all did in Q4. And despite the fact that we've had over 30 VLCC deliveries hitting the water in Q1, and the fact that we've had 1.2 million barrels a day taken out from the OPEC cuts, and we've had a longer and a more deeper refinery maintenance program in that time. So we're reasonably sort of impressed that there's a resilience to the VLCC market, and that we're at this base rates of cash flow positive and net profit generation, despite the fact that we've had those headwinds. And those headwinds now start to unwind as we see the disruption from IMO 2020 and vessels being taken out of the market to retrofit. The Iranian vessels could see another sort of 10 to 14 disappear. So we think there's some really good grounds to believe that, which I think is becoming a slightly consensus view, that Q2 could actually be, if you like, the ordinary usual Q3 bottom. So we think we're approaching the bottom for the VLCC freight market at the moment.
Great. Lois, what's your perspective on that? What do you think about sort of rates maybe kind of stabilizing, even though fundamentals maybe aren't as good as they were a few months ago?
Well, it's interesting because Q1 really, the market resurgence really wasn't due to IMO 2020 or anything like that. I think it has a lot to do with what Brian's talking about with those incremental barrels going long haul to China, out of the U.S. Gulf, and you saw that market really respond, and whether or not the barrels are actually going to go to China or they're going to go to Japan and Korea, we're seeing less China than we see often more of the other Asian countries. So we're looking for those long ton miles, which again are something north of 110 days on a round. And that really adds a lot of demand and has helped that VLCC market thus far this year. So that's in advance of 2020. Those are just fundamentals of where the crude's coming from and where it's being demanded. Yep,
that makes sense. Ted, how sustainable do you think that sort of higher ton mile dynamic is, particularly U.S. Gulf activity?
I mean, it's very sustainable, and it's going to get better. I think from 35,000 feet, in the east, you have more oil required. Chinese are producing less oil. Here in the west, besides us, the U.S. becoming the new OPEC, the new Saudi Arabia, Brazil's going to get better. So there's a lot more oil coming from the west. And in the middle of the picture, you have core OPEC cracking more of the barrel. So not only is the replacement going to have to come from the west, but the shortage of what's going to go out there, or the new oil that's going to be moved, is going to start from the Atlantic. So ton miles looks very good. We're going to do the premium pipelines, the second half of the year. You're going to have berths coming on. I think this is a mega trend that's just in its infancy.
Yeah, no, that makes sense. And you guys are just queuing up the next question each time, so these are phenomenal answers. It really makes my life a lot easier here. Bob, from your perspective, can you give us a view on what you think about sort of infrastructure build-out? It seems like things are going on in the Gulf Coast, direct loading of VLCCs. When do we think that could potentially happen off the U.S. Gulf?
First of all, it's amazing we all think the market's going to go up. What an unusual group of ship owners.
This is the happy panel.
I mean, from what we read, what we see, it's going to be, it's going to be a gradual process, but a year and a half from now, 2 years, there'll be more pipelines. Some Vs will be loading directly, maybe not 100% loading, but it'll take away from some of the, what do they call it, reverse lightering that's soaked up a lot of the Aframax tonnage. So that'll take place. And one thing I want to mention, I think a lot of the refineries are undergoing a lot more maintenance than usual and gearing up towards, a flat-out run for 12 or longer months, anticipation of 2020. And I think that's sort of the underlying, fundamental that's going to help us out through that period.
That makes sense. And Nick, I want to get you involved here. There's a good comment just now about the reverse lightering. And how do you think, if you think out over the next couple of years and say the U.S. Gulf exports continue to grow, what do you think the impact will be kind of across the fleet, not just on the V side, but also on the smaller vessels as you cascade lower?
Well, I agree with Bob that we would rather have the developments of direct loading and of VLCCs to be a slow process. We would like when this process, and if this process finally becomes fully efficient, it will reduce the lightering, which is such a big historic part of the Gulf, mainly on Aframaxes, and sometimes on Suezmaxes. So I think that will be, it will reduce the demand for those vessels going forward, which is something that we do not see today. I think today we're seeing a lot of appetite from the oil companies and the end users to charter for the next 3 to 5 years a lot of second-hand tonnage in the Aframax and Suezmax categories. So, I mean, this is a positive note. We had not seen this a year ago. We're just coming out from, we just came out from 2018, which was 3/4 of it was a very painful year. The last quarter we had a happy ending, but it was not, it didn't last as long, although the market right now is it's much healthier than what we experienced a year ago. So far, both Aframax and Suezmaxes are there for demand for long term.
And I wanted to maybe, anybody can answer this question, just wanted to get a sense. Each one of you guys have various parts of the market that you've historically focused on, and some have had more mixed approaches. Are there any areas that you see, I mean, VLCCs get a lot of attention from guys like me and investors in general. What are the other areas that you think we should be focusing on, or are there other asset sizes that look interesting in the next year or two that you might want to be spending more time on? I don't know, Lois, you want to take a crack at that? Or?
Yeah, sure, absolutely. I mean, and it's interesting because we actually are, I think, the only company here that has any involvement in the lightering business, which is largely performed with Aframaxes. But what's interesting is that, while the U.S. Gulf is the largest area where lightering is growing rapidly, we're also very active in Panama, on the U.S. West Coast, the Bahamas, and, there are growth areas, like Brazil and other areas that will grow with lightering activities as it kind of offsets the Gulf. So I mentioned that specifically because the Venezuelan situation is very tenuous right now, and with exports having been halved out of Venezuela, that particularly falls on the shoulders of Aframaxes and somewhat the Suezmax market. I'm thinking that the U.S. refiners still need heavy crude imports, and they're not going to get all of that from Canada or U.S. offshore. Mm-hmm. And so that is likely to come from Russia and other areas on Afra and Suez. So when you see these things that happen in our market that are unplanned, that affect the production, those mid-sized vessels are highly affected by that, but it doesn't mean that they're down and out. As Nikos said,
I think Lois mentioned the U.S. Gulf. Of course, we're all U.S.-centric, so unfortunately we don't get the same breadth of information elsewhere in the world. But I think the U.S. refineries obviously specialize in cracking high sulfur crude, and with Venezuela out, that'll take more heavy sulfur crude from other parts of the world that are obviously further away than Venezuela, such as Russia,
Thank you.
or even West Africa.
Makes sense. Ted, what are your thoughts on asset sizes? What are you guys thinking? I think there saw a sale this morning of a V, if I saw that correctly. Just kind of curious how you guys are thinking about it.
Well, we got rid of one of our older vessels. You know, the market's good. You can get a decent rate for these vessels. The problem is you trade them in the East, right? And so it looks like there's the buyers are going to be floating storage. So they paid up front, well above scrap for us. We were very happy with that. We appreciate all the other sizes, but going back to when we commenced NNA and we wanted to look at the market, we thought China was the big 400-pound gorilla in all the markets. And if you're going to play China, you're going to play the Vs. So that was our. We like the other sizes, but we've been in Vs, and I think we'll stay there for a while.
Brian, any thoughts there? You guys have obviously been, made a bet on Vs for a while.
Yeah, we're very focused on that. I think one thing that's beginning to occupy more minds on a more strategic basis is about the real medium-term propulsion and sources we're going to use, be it LNG, hydrogen, all of these other areas, not just because we've obviously got a fuel oil source issue coming, but no, I think we've made our structure pretty clear, and it's about making it work better, and the consolidation doesn't just have to be M&A, which gets everyone's attention, but come and join Lois and ourselves in the pool, and we can do the commercial consolidation, which can help drive those better returns.
Yep, makes sense. So let's talk a little bit about rates and sort of the outlook as we look out through the rest of 2019. So I think there's some conventional wisdom in the market that maybe we'll pull forward seasonality by a quarter or so, just given what's going on at the end of the year. I don't know if that's something that you all agree with, or do you think that maybe there are other nuances to the implementations of IMO 2020 with dry docking or otherwise later in the year that could impact that? I don't know if any. Ted, you look like you want to answer, so I'm going to throw it to you, and then maybe Bob next to you.
Let me go ahead.
It's not just IMO, right? Supply and demand fundamentals are actually very good, and anything that's holding back the market is front-loaded. You had, as Brian was saying, there was a lot of deliveries that everything everybody waits for that extra month. We chew through those deliveries, right? The refineries are doing the extra maintenance, so they've stopped buying the crude, and we're still averaging, on the Clarksons, and I think the Baltic is about 29,000 for Q1, right? And you also had OPEC cutting, and maybe they may cut some more, but when the Saudis get to their $75, because they have, Aramco has to continue making $111 billion a year, as they reported this morning, then I think the second half gets better. And then IMO on top of that, right? So the whole issue of, it's about 35, 40 days to just get the ship ready in dry dock to put the, you don't have to be in the dry dock, but you have to be out of service. So I think there's a whole bunch of issues. Besides the ship slowing down, go from 13 knots to 12 knots, it's 8%. Okay, half of that's ballast, so it's 4%. You're out at sea only 2/3 of the time, but it's a 3% reduction. Just, simple math, because I'm not as smart as Lois, I can only do the simple stuff.
That was pretty good.
And so you're 3% reduction just in reducing 1 knot of the fleet. So I think everything is, the second half gets much better than the first half, and the first half's not so bad. You'll have seasonality in Q2.
What he said. Plus, anything that's disruptive or inefficient in shipping is obviously good. And it's hard to quantify a lot of these issues. But if you just look at the list of them, I just wrote them down quickly while Ted was speaking. The scrubber installation, low sulfur and high sulfur crude movements are going to change drastically as the demand for different types of fuel changes and the demands on the different refineries change. Storage is increasing. There are tankage issues. There are bunkering issues. So all these issues are going to cause massive inefficiencies, and anything with inefficiencies is good for shipping. And the order book is baked in right now for the next 12 months, 18 months. So we know the supply side. So, I think as a group, as ship owners, we're generally optimistic. I think as the crude panel, we're overly optimistic, and I think, it looks good for the second half of the year.
Yeah. Nikos, please.
Yes, I agree that we are optimistic because we're coming from a very, very low point you. It's like the Greek economy. Everybody talks about how the Greek economy is doing fantastic, but it's been on its knees. We have lost 40% of the GDP, so the only way is up from now on. It is a healthier environment. I know we all want to get our share prices up here, but I think let's not get over-optimistic and start thinking of ordering new ships, because that, again, is going to put a cap on whatever we're trying to do here. There's a lot of ships out in the market, and there are a lot of ships coming in the market. Last time I saw, I think there are about 100 VLs that are going to hit us in the next 2 years. Mm-hmm. I remember back in the 2008 period of excitement and happiness, we had 52 Panamax bulk carriers coming in a year, which was one a week, and that was huge for the time. Now 100 VLCCs is even huger due to their size. So I think we are going to see a better time. I hope all our shares have tanked and they have only one way to go, but let's not get over-optimistic, because this is what really brings the market down on the long term.
But Nick, I think you're right, of course, but there's not a lot of capital out there that has moved quickly into shipping. A lot of the capital is stuck and they want to get out. Most of the public companies have a hard time raising any kind of equity because their stock is below asset value, and the PE guys are kind of exhausted. So, I think one of the problems with shipping, one of the many problems, is that people can employ capital quickly. For anyone who invests capital for a living, it takes a year or so to do a real estate deal. I mean, any of the two of us could go to Korea on a day trip and order $500 million worth of ships by lunchtime tomorrow. And that can be really tempting for people who are in the business of putting capital to work. So I think that's a real positive for us.
Well, I think you are right that from the normal sources of finance, there is a lack. But don't forget, you have this very excitable and exciting Chinese leasing associations that, they can give you a ship with 95% finance. And this is another danger that in the market. So I agree with you that you don't have equity. Traditional bank finance is a bit more skeptical, but I think you have other sources that can create, if anybody wants to go and spend $500 million, they can do it.
I mean, if I can just expand on the points the gentlemen are making. When you're looking at the crude tanker fleet and you're thinking about ordering, one of the things Brian mentioned is, what is your propulsion going to be? And it makes, I think it should make every owner hesitate, or every investor hesitate a little bit. There are secondhand values out there available. Those vessels have not run up dramatically in value, and they're probably a better deal rather than running out and ordering a new building for delivered 2021 with a propulsion that's going to be redundant in a year or two, because I think we're at a watershed moment.
Very good.
That's great. That certainly makes sense. So it's hard to separate the fundamentals, Ted, to your point. It's hard to separate the fundamentals from what's going on with IMO. If you're to do that, though, just to take a step back and think about it, what would sort of the normal cadence of sort of rates look like as we moved out over the next 18 months? Would you see the typical sort of fourth quarter, rally that you'd expect? Could you see some activity before that? If you're, again, to separate the two, I know it's difficult to do, but I'm going to ask you to do it anyway.
Well, seasonality tells you that Q2 and Q3 are, if you take 100 as the average, Q1's usually at a little bit 90% of the average, Q2 is probably a little less, Q3 starts going up, and Q4 is usually 40 to 50% above the average. So, but you can really see it. Look, if you look at the futures today, Q4 into the end of 21, so 9 quarters, you could lock in 34,000. Doesn't mean everybody's right, but it means people are seeing in the future that they want to lock in something. Right? I know all the shorts are coming to the longs these days. I'm sure across the board here, more calls are coming into our trading group than going out.
Yep.
And they're just, hey guys, how you doing? What's going on? We know they're ready to start the mating dance. It's just a matter of what we're going to fix.
But Ted, on that, do you think they're all waiting for 2020? They're all sort of waiting on the sidelines as well?
It's hard to. I would say if I'm a charterer, I would wait for seasonality and see if I can get $1,000 less and try to lock it in before things start moving. I think you're going to see a lot of them come to the meadow with their sheep now to try to get everything done, because I would if I was a short. I just think, again, everything, we were talking about what could hold the year down. Well, we're going to have 5% fleet growth probably in Vs. It's not that great. Having said that, we have circa 100 vessels on water, 85 will deliver. That's about the same amount of vessels that are 17 years in age or older. So if you look at a 3-year period, it's much better. And I think it'd behoove us not to be fixing, like we wouldn't fix out a period more than a year today unless we had an index related. It's got to relate to the market going forward if we're going to do it today.
Would you, as asset owners, be hesitant to charter out ships in the back half of the year because of concern that you might miss upside, or we're willing to do it, so you'll take that index link to it?
Question. Listen,
it could be anybody on the panel.
oh, sorry. Good.
Feel free.
I mean, the longer term market in tankers, it's not like we're at the LNG place where we're doing to 7 to 12 year deals, that actually provides a proper return. So, once you get to those kinds of levels, I think everybody's, certainly at our house is listening.
Yeah. I'm guessing the same for you.
Yeah, at today's rates, we're going to wait a bit and see what happens.
Yeah, see you. Okay. That's great.
I think the idea, I agree with you. It's always good to have full utilization. This is what we try in our company to do, but you have to tie it with some sort of index-related upside going forward.
And Brian, are you guys happy to play the pool?
Yes, but at the same time, I think it's like everyone's saying, in particular Ted, I think makes a very good point. When we start seeing that demand as it's coming through, and those inquiries are coming through in a seasonally, supposedly weaker quarter, that's, if you like, the canary in the coal mine. That's when we start seeing they want to capture that level of fleet. If that's going to happen from the charterers, then we know that they've got the same belief in us on the rates in 20 and 22, 21.
We have older tankers, and we get constant incomings for storage. So you see it on both ends for...
Yeah. Okay. And we've always talked about that older supply of ships that can match order books and so on and so forth. What is IMO a catalyst to actually get those ships out of the market? If not, what would be?
I think the market takes those. The market differentiates those ships. And there's always a market for them, but it's not as efficient as the ships that are, let's say, 15 years or younger. So those ships will tend to trade more in the Far East, and that's why you see the Far East market, which performs much worse usually than the West.
Yeah.
And so the IMO might make your decision to sell a vessel for scrapping closer to its, let's say, intermediate survey rather than the special survey by 2 or 2.5 years.
But there's also, I mean, when you're in, we have older ships and you look at two different markets, which both have a lot of volatility. You look at the scrap market and you look at the V market. So you're looking at how many days left in the life of your ship, literally 500, 700, or 1,000, versus the volatility in the scrap market, and you make a decision based upon those two markets, which is fun. But also, they do trade a discount to the newer vessels, and that discount gets fairly narrow as the market gets hotter. And of course, when the market's bad, they don't trade as well. But the capital cost is much lower, and that's what we look at. It's a much lower drag on your capital cost. So we try to weigh that against the trading discount. And over the past year or so, it's worked well for us.
But I think that's a challenge as well, that we get asked an awful lot about, well, what's the scrapping number going to be this year? But Bob's just given a great articulation there about it's an individual decision. There's 100 different VLCC owners, there's 100 different Suezmax owners. That's a bottom-up decision based on a whole range of factors. We're being asked to make a top-down sort of assumption on what that would be. But it's also interesting as well that we're already getting this storage inquiry. That may put a bit of a cap on scrapping this year, regardless of rates. But like I say, it's the factors both guys have said already. You've got that older, the average age of the fleet has seasoned quite aggressively in the last 2 or 3 years.
But if they go in storage, they're out of the market. So they're out of the commercial market if they're in storage,
Got it. What do you think about trade lanes post-IMO 2020? What's the most exciting aspect of something changing there? Obviously, you're going to need lower sulfur crude in different places. You'll need higher sulfur crude in other places. What do you think are the potential opportunities there? And how do you think about average ton miles per voyage?
Does anyone else dream about that?
We have to think about, so curious.
I think one thing that we've looked at, and we've done some work with Braemar on this, is that, and it's a point Lois made earlier, is that the Chinese, they may have been buying some of these cargoes, but they haven't been delivered to China.
Yeah.
Japan, Korea, Taiwan and India has taken up the slack almost dollar for dollar since the Chinese stopped buying in the summer. So you could see another leg to the ton-mile story that Ted talked about earlier. But I think that's got to be, as all the panelists have said, it's an exciting part of the story, that trade of US exports, because there's a real longevity for the next 3 to 5 years on that. But it's also interesting trades that we think will be something like the Russian crude to the heavy sales to the US. That's something which we're already starting to see some volume on.
I think it's important also, because you spoke about the next 2 or 3 years, to see what will happen with the various embargoes that are out there.
Yeah.
If we have what happens to Venezuela, if Venezuela becomes again, a much more closer pipeline than right now, which it's not playing any significant role. What will happen with Iran, if Iranian oil will come back in the market? So you have those geopolitical events that play a significant role also in the next 2 to 3 years.
I think the natural arb from the Baltics out to Singapore for fuel oil is going to go away. I think the refineries in the U.S. East Coast and Europe are in trouble. How fast they are phased out, I think, there are economic issues, also political issues as to how that happens. And I wrote down something else here. I can't quite understand what I put, but I'm sure that one's true too. So.
That sounds like your handwriting's like mine. Okay, that certainly makes sense. I guess when you think about IMO and the potential for any pull forward of activity, in the back half of this year, so as we're starting to think a little shorter term, what do you think are the direct sort of impacts when you think about it? Is it people putting ships for extended periods into dry docking as they go through the scrubber installation? Is that something that has a meaningful impact? Will it be the beginning of the dissemination of low sulfur fuel into the market? What are the sort of nearer term disruptions that you guys are thinking about that should be on our radar screens for the next couple of months?
I mean, for sure, scrubber installations, I think in Q3 will start quite intensively.
Yep.
There are some people who are having scrubber installations now, which is super, but it's a challenge to get all the engineering done and have it installed at the low of the market, which would be right now.
Yeah.
So I do think that will be an impact, certainly on the V fleet, where you have over 200 ships that will have scrubbers, whether as new buildings or retrofits. So that's one significant impact. And another one is that for owners, to put the light sulfur on, we want to do that at the last moment, at the cheapest price, where it's most convenient. And since that's pretty challenging, you're going to start to see all the technical guys really planning that out, at least in Q4, if not before.
Yeah. I don't think any of us have an answer, and that indicates that there are going to be a lot of inefficiencies and mistakes, which leads to better rates. It's like Ghostbusters, cats and dogs living together. It should be confusing. Even the scrubber issue, we're installing 6 scrubbers, and when you put a ship in dry dock, usually you have a few dry docks that you're discussing it with, and the time is flexible, and you work your ship out that way, and we've all gotten very efficient at doing that. A scrubber, you have to get your ship to a certain yard, because the scrubber's there waiting for you. So you have to get your ship to that yard to get that scrubber on. So you have to work in cargo in that direction, or ballast part of the way, and then the scrubber has to arrive on time with all the parts that you need. So it just adds more inefficiencies to a process that none of us have done before. And we all have budgeted days, and we're going to be very efficient at cleaning the tanks, but none of us really know. I think that's what we're excited about, is that none of us know, and it won't be that efficient.
I think the pull ahead of the cargoes, the advancement of the cargoes, 2 things about it. One, it may make an artificially higher second half of the year and then artificially lower first half. Not by much, but it's artificial, right? Mm-hmm. But I also do think that, what's the spread going to be? Right? The higher the spread, the more you're going to pull cargoes forward.
Yeah.
So I think last year, if I remember right, there was talk of 350, 400, maybe more. It seems that's kind of come a little bit, that's collapsed a bit. Now, a lot of us follow, there's a futures market for gas oil versus high sulfur fuel in Singapore, and there's a futures market. So, that's probably, I think 250 I saw last. It's sort of a synthetic spread, right? Sure. But it's at least a picture into the future. It will be higher. There will be the fleet slowing down, but it's a matter of how long and how high.
Yeah.
Right? Or how low and how long.
But there's less high sulfur crude out there than there used to be. I mean, Venezuela's gone, Mexico's way off, Libya, Iran, they're all high sulfur producers. And that is an underlying problem for people who have ordered scrubbers, because the spread the basis will be lower because the spread between high sulfur and low sulfur crude is lower.
It's amazing that Paddy Rogers is not here, so we can talk about scrubbers without having to hide under the table. I think that's
He's phoned in. He's going to dial in. Start talking at some point.
Well, I know where most of you stand on scrubbers, but I think for the audience's point, maybe each one of you can make a comment on whether you're making an investment or not making an investment in scrubbers, and we can see how maybe diverse the opinions are in this market, truly, how they truly are.
Euronav are not making investments. From our perspective, the analysis we've done, the rewards and returns, given the risk profile that we've assessed, do not make sense for us at this time.
Lois?
Yeah, for us, we're investing scrubbers in our 10 modern VLCCs, which represent just shy of 40% of our bunker portfolio, which we think is a balanced approach.
Okay. Ted?
We have scrubbers scheduled to go in on those new buildings that are delivering next year. Other than that, we're looking to the charterers. If they want to pay cost plus, we're happy to do it.
Yep. Bob?
Yeah, we have 9 MR tankers, and they will not have scrubbers. We have 8 Suez, 6 of which will have scrubbers, and we have 7 older VLs, which will not have scrubbers. They only last a few more years, and we're hoping to take advantage of the spike in IMO rates in the short run.
Nick?
Well, we're only fitting scrubbers. Our clients and our charterers. I mean, our strategy is always with long-term charters. The majority of our fleet is in 5 to 10-year employments. So if the charter wants to spend the money and to pay for the time, we do not encourage them. But so it seems we're going to have 6 scrubbers fitted on 2 VLs and 4 Suezmaxes. I have to say, a year ago, we had many more of our charterers asking us to give them permission to put scrubbers, which we did. And since then, we hear less and less of those demands. So this is, I think, a good sign. The best thing that can happen is everybody goes to put scrubbers very soon, have huge delays, get the market to skyrocket, and then by the time the ships come back, you will not need scrubbers anymore. So I think that will be our game plan.
There you go. That's probably the right answer. So just to wrap up here in the last 2 minutes we have, most tanker equities are trading below net asset value. So what do you do? What is the priority today in that environment? Brian?
We've done about, I think, just over $20 million of buyback on our stock since the end of December. We're trading at a 20% discount. If we look historically, the correlation with new build asset prices since 2004 in Euronav stocks around about 85%. It's about 65% when you compare it to the earnings. So historically, the asset prices do tend to price recovery in pretty quickly. I think in terms of that asset allocation, we'll be more skewed towards that rather than dividends going forward.
Yeah, for international Seaways, I think as we are in the low part of the cycle, there is a renewed interest. We were discussing it. You're starting to feel that inquiry into the tanker business, and hopefully that's going to reward having paddled really hard while the market was down.
Okay.
Yeah, well, you simply perform. Wherever the market's valuing you correctly or incorrectly, you simply perform. I think the second half of the market, there's an investor fatigue that's been here since people went in as dry bulk a few years ago.
Yep.
Let that be the case, so no new buildings come in. But I just think you look forward and you perform. And as Lois says, I think it's the wrong time to be putting out steel for a long period at this point.
Got it. Different perspective from your standpoint, but what do you think?
We're privately held with various public PE firms that own us. It works for me that they're undervalued because it's difficult to raise money in order to new ships. That's all I'm going to say.
Fair enough.
Good luck, guys.
Yeah. Nick, last comment from you?
I think it's not a new thing not to be trading way under net asset value. Let's hope that this year at least we will be able to arrive to net asset value. I think this is our target right now.
Got it. Lady, gentlemen, thank you very much. Appreciate it.
Thank you. Thank you.